So, Marvin, what are your thoughts, given the sentiment leading up to this, and especially what we've seen in terms of the Fitch downgrade for U.S. credit rating, some of this creditworthiness issues that we've seen with Moody's downgrading of the banks? What are you expecting tomorrow?
Sure. A lot to chop through for an August summer. So, we have access to some online pricing data. Our online pricing data is showing, a little bit of a mixed signal. There's a little bit of an uptick near the end of the month, but at an industry level, it's seeming pretty stable. So I think in line is probably where we're expecting tomorrow. Every data point is important. We've kind of seen how the markets have been moving on these data points. So, certainly there's probably going to be a bigger market reaction if we see a tick up inflation, because the broader story has been that it is moving in the right direction. But, at the moment, 0.2% for the month over month data is what we're looking for.
And how much of some of the jitters that we're seeing are going to end up doing some of the Federal Reserve's sort of tightening for it, as there is this sort of trepidation about what happens next? Yeah,
absolutely. I mean, the market has gone all in its view that for the most part, the Fed's going to be done. And it really is looking forward to a normalization of that higher policy rate. How we get there is kind of where the debate is. Does a recession push the Fed into cutting rates, or does a soft landing let them more naturally do it? So September is still alive. They've been pretty consistent in saying that every meeting is live. They still have one hike that they expect to do based on some projections they put out in the middle of the year. So having said that, if we wind up with a hot print, it does bring September back on the table and kind of probably revitalizes the story that the Fed might not be done yet. Right now, market pricing is really looking at the Fed being done, though.
And I mean, as we look at some of the flows that we're seeing, we are seeing more liquidity coming off of the sidelines. But what kind of flows are you seeing from institutional investors, and where are they putting their money to work?
Yeah, for sure. So we have access at State Street. It's wonderful to a lot of data that's part of our custodial business, and we have seen a lot of that money coming off the sidelines. Our institutional investor indicators shows one of the biggest increases that we've seen after kind of this real money set had been negative for the better part of this year. So kind of that fear of missing out is definitely pulling money off of the sidelines. From an asset allocation perspective, we are seeing it moving out of cash into equities, and just kind of having sat in the seat for a while, this momentum that often makes its way in the market has a tendency to last longer than you expect. So, that's certainly encouraging for the bulls, but valuations where they are always kind of keeps you a little bit concerned that any bad news print or any bad data print is going to kind of change the narrative quickly.
And, we're looking at this sort of shift from a hard landing to a potential soft landing. We spoke to Christina Hooper from Invesco. She sees more of a bumpy landing, sort of, it's not going to be smooth sailing either way. Yeah. But in terms of the recessionary catalysts then that you think investors might be missing, or which ones are you keeping an eye on?
Yeah, you know what? So the data has certainly been encouraging, and risk assets have ultimately been right. The data has been better than expected. So you could say that the markets were once again right and ahead of itself. I still think that we've got a bumpy road ahead of us. I do think some of this credit stories, the credit tightening that we continue to see, some of the credit card data that was released yesterday in terms of a record number of credit cards. Having said that, we see default rates going up. So, I think that still is in the background. I view that as one of the more important stories, which, if you kind of look at the banking sector, seems to have been pushed to the background, but overall, credit creation is important for this economy, and I think that it becomes a challenge whether or not we're going to see the degree of credit creation that justifies the valuations a lot of these risk assets have kind of priced in.
And we know that there was certain low expectations coming into this earnings season. Yeah. But as we begin to sort of digest some of these bellwethers that have been coming in, how are you feeling about earnings season? And have you seen any surprises at the moment? Yeah, I mean, certainly, the whole cut expectations and then beat was on full display. We could say that for the better part of this year. We started this year thinking that earnings were only going to grow in the low single digits. We're probably going to shrink by the low single digits. So, all in all, given the concerns, that's a win. We go into next year where expectations are double digit, looking at 10, 12% growth, expecting that 10 to
15% growth, if you will, going into the year after that. That metric's a lot harder. So, certainly looking for sectors that are able to maintain their margins, sectors that might have some revenue upside associated with it, and really kind of positioning for a potentially, like you said, more bumpier type of landing going forward.
And then obviously we're keeping one eye on what we've seen with some of the data coming out of China and the deflationary pressures there. In terms of some of the issues outside of the US that investors should be at least mindful of in terms of how it might impact investments in the US, what are some of the standouts on your list?
Yeah, for sure. The China story always is front and center. It does look like they have a lot of wood to chop. It does look like it's a hard go for them. They've been slow in their stimulus. There's probably a reason for it. It's harder for them to stimulate kind of given where the economy is at that point. And all of that does flow into either the region. So, a lot of Asian markets are very tied to China. And then if we were to think about it beyond that, certain developed market regions are more reliant on China. Europe kind of comes to mind in terms of a closer relationship than what we have here. The positive side of it is that from a goods deflation, disinflation, however it evolves perspective, it does kind of help this inflation story. So which markets might benefit the most, particularly on the goods side of things, if China's deflation does make its way into their exports?
We'll certainly be keeping an eye on that. Great to have you on the show today. Marvin Lowe, State Street Senior Global Macro Strategist. Thank you for your time this morning.